Illinois Toolworks delivered a clean double beat for Q2 2026.
Yeah, they really did. Revenue hit $4.3 billion, which is a 6.1% increase, and GAAP EPS came in at $2.84.
That's what, up like 10% year over year?
Exactly, 10.1% to be precise. And management actually raised their full-year EPS guidance, up to that $11.35 to $11.55 range. Plus, expected revenue growth is now bumped to 4 to 5%.
Right, and the market loved it. I mean, the stock gapped up 5.79% right at the open.
Yeah, it settled a bit, but still closed the regular session up 4.9%, near $296.89, I think.
Yeah, but here's the wild part for today's deep dive. If you look at the volume, it was unusually low, like a total vacuum of sellers.
Right, so any buying pressure just launches it.
Exactly, like a seesaw. Everyone jumps off one side, so even tiny institutional demand pushes the price up with zero technical resistance.
It looks great on the surface for anyone holding ITW stock right now, but when you look at where that revenue actually came from, there is a pretty massive contradiction.
Oh yeah, the segment divide is incredibly sharp.
Completely. It wasn't some rising tide lifting all boats. Heavy industrial capex just absolutely surged. I mean, welding was up 13.9% organically.
Which was mostly domestic equipment, right? Like a 19% surge there.
Yeah, exactly. And then test and measurement plus electronics rose 10% organically, riding those strong semiconductor cycles.
But then you pivot to the divisions tied closer to the consumer, and it's like they hit a brick wall.
Brakes locked up entirely. Automotive OEM was organically flat. Europe was actually down 5%.
Wow.
Yeah, and food equipment saw literal zero organic growth.
Okay, wait, so if massive divisions like auto and food are completely flatlining, how did they possibly manage to expand overall operating margins? Because they went up 40 basis points to 26.7%. That just shouldn't happen.
You would think so, right? But it all comes down to internal execution, specifically what management calls their customer-back innovation pipeline and their 80/20 operating strategy.
Right, the 80/20 strategy, which sounds like total corporate buzzword bingo.
It really does. But in practice, those enterprise initiatives added 120 basis points to the operating margin, completely offsetting the drag from auto and food.
Basically, they are ruthlessly cutting the bottom 80% of distractions, underperforming product lines, inefficient administrative processes, to just obsessively focus on the top 20% of products that actually drive profit.
Exactly. They aren't just selling more, they are selling much smarter. That intense focus is what's keeping those margins inflated despite the dead weight.
I mean, I hear you on the internal efficiency, but they can't just efficiency their way out of a bad macro environment forever.
No, they can't. At some point, reality catches up, and that is the primary risk capping their future upside side. A severe price-cost timing lag.
Because they're getting hammered right now by inflation in like crude oil, derivative resins, and chemicals.
Exactly. They are feeling that raw material squeeze right now.
And that lag exists because ITW is locked into these long-term customer contracts, right? If the cost of chemical resins spikes today, they can't just legally raise their prices tomorrow to match it. It might take 3 to 6 months to pass those costs along.
Precisely. That time gap is eating into their profits as we speak. In fact, that specific timing lag diluted Q2 margins by 40 basis points.
So management says these headwinds will diminish in the second half when pricing adjustments finally kick in. But you have to wonder if they're being overly optimistic.
You definitely do, especially when you weigh that optimism against their valuation risks. ITW is trading at a 27.7x trailing PE.
Wow. Okay, so a multiple that high leaves absolutely zero margin for error.
Absolutely zero. Can those pricing adjustments genuinely catch up to raw material costs as quickly as they model? Because if chemical inflation spikes again, they are just going to be chasing their own tail.
Right. Does this timing lag just represent a structural ceiling for their incremental margins?
That is the critical risk you have to watch. It leaves you with a final thought to mull over. Right now, Illinois Toolworks' bottom line expansion is heavily subsidized by financial engineering and those internal efficiency gains.
Yeah, they pulled forward a massive $750 million share repurchase just in Q2 to reduce the share count and boost EPS.
Exactly. So what happens to that premium valuation if this heavy industrial capex cycle suddenly cools down and they've already pulled all their efficiency lever?
A fascinating question to keep an eye on. Make sure to follow the show for your daily earnings coverage, and we'll catch you next time.